Hey, good morning and welcome. I've got Greg here. Steve couldn't make it today, but we are going to continue our conversation about credit spreads. And Greg, you can let us know. We were just talking about one that has kind of gotten away from us. I'll let you kind of kick things off, tell us where we're at and where we're going with the next one.
Okay, thank you very much, Ben. What I'd like to do in this chat room and during this hour is I want to basically do two or three things. I want to have a quick conversation about what's going on in the market. I want to go over the potential trades and the trades that we've done, look at stocks. And then I want to, teach you a little something every week. And so that's kind of the plan, the outline for today. Okay, so before we jump into the whole credit spreads, let's talk briefly about what's going on in the market. Okay, right now, the stock market has been trending down for about 3 weeks. And, really, that's no big deal. It's very normal for that to happen every year. It's a seasonal thing. From May to September, it tends to be the weak time of the year. There's an old saying in the market, sell in May and go away. Well, there's truth to that. And I'm going to point that out to you if I can set up the screen share. So let's look at that real quick, if I can do that. Hold on just a moment. I'll keep talking while we do this.
All right, I'll just
okay, can you see it's coming up slow, but in a moment you should be able to see the Dow Jones Industrial Average. Can you see that, Ben?
Yep.
Okay, good. This is a typical pattern. It hasn't happened so much over the last 5 years where everything has been so unprecedented. But this is the normal pattern in the market. You see that in the market here, this is the year 2010, if you can see in the lower left-hand corner. The market topped out almost exactly on schedule in late April, and it pulled back over the next 2 months or so. Okay, so that was 2010. That's a 13.5% pullback right there. That's very normal. It happens just about every year, a 5 to 15% pullback in the market. And so the fact that we're down 4% right now is no big deal at all from the highs. Okay. I noticed that in the market right now, there are stocks that are trending up and other stocks that are trending down. And that's what you want to look at. Where is the trend? Because people sometimes get lost in the short term, noise and volatility of stocks. Excuse me. So what you want to do is look at the trend over the last month or so, because that's what you want to go with generally. Okay. Now, there's something important else that we need to talk about, and that's Evergrande out of China. The market took a big hit on Monday that really surprised me in response to this great big company in China, real estate company, that may default on their bond payments. And it really shocked me because it's only a $35.9 million bond payment. It's going to be due tomorrow. Now, if they fail on that, just based on what the market did here on Monday in response to that, there might be some fallout in our markets. And so it'll be interesting to see what happens tomorrow with that. I expect more volatility in the markets in the coming weeks. So we'll have to keep an eye on that. Okay. Did you hear about that, Ben? The Evergrande thing?
No, I didn't.
Yeah, that's why the market took a hit on Monday. It's a global marketplace these days. And so China is now a huge economy, the second largest in the world because they have so many people. And we do a lot of trade with them. So what happens there is going to affect us. And that showed up in the market on Monday. So that's really important to know that what happens there, tomorrow's going to be a big day to see if they default on their payment. I was reading about that in the Wall Street Journal this morning. And so that'll be really good to take a look at, okay, and to keep an eye on. I also saw another article this morning that said the Fed taper was going to be done by the middle of next year. So it sounds like they're getting serious about that. We'll see. Anyway, so that's what I wanted to talk about that. So let's move forward then. Let's look at some trades that are going on right now. Let's talk about this trade that I did with American Express. I sent out an alert a few days ago saying that it looks like American Express, let me make it a little bit bigger, right about here, I said that it looks like American Express is going to break through support and go down. And so I issued a bearish credit spread, which means we don't think it's going to go up, and look what happened, it went up. We sold the 165s calls, and for protection, we bought the 170 calls. Now, obviously, that didn't work. What happened was, the only news I can find out about this really is that an analyst upgraded the stock, and the market is responding to that. Wasn't expecting that. That's like a curveball coming from outfield, hitting me in the side of the head. So we've hit a max loss on this right now. Now, if the stock, comes down, it doesn't matter so much where the stock goes during the trade for a credit spread. Options are usually not assigned until expiration. Okay, so at this point, since we've hit max loss, there's unrealized loss. The best way to manage it is just hope it comes back. Don't exit the trade. There's a possibility it could come back. I don't actually think that's going to happen, but unless you're assigned. Now let's talk about what happens if you are assigned. That essentially means the leg that you sold, the 165 call, you're assigned, then so you're out of that. That means you're only holding the 170 call that you bought. So so what that means is if you're assigned, you're only holding that 170 call. So then you need to manage it as if that's the only trade that you did. So if you think that American Express could go up from here, then you just hold on to that call, and maybe you can make enough to offset the losses from the other call. Does that make sense?
Yeah.
Ben, okay.
Well, for me, for anybody who's watching, is that pretty clear?
However, if you're not, again, if you're not assigned and you still hold both options, you might as well stay in, because if it comes back, you can possibly make a profit or regain some of your losses. So that's the way you hold it. That's the way you manage it. You just hold on and wait and see what happens. Okay. Do you have any questions about that? If so, go ahead and write them in. Okay. So that one didn't work out. Let's look at some other stocks now. We'll wait for my computer to catch up here. So here's another stock. This is the Mosaic company, internet company. I drew the lines of support and resistance on the chart here. Can you see that, Ben?
Yep, perfectly.
Okay, good. I hope that's large enough so you can actually see it. This looks like it clearly is in a sideways range, but I can't tell if it might be ready to break out. So I'm concerned about buying. I'm more bullish on this. So I'm more likely to sell a put way down here at support. The thing is, at this price, you're not going to make a lot of money to do that. I would rather wait on this and see it come back down to support around $29 a share, see it start to bounce, and then do the credit spread. You do that because you'll make more money on it. It's too far away from support to do that trade right now. It's not worth the risk, in my opinion. You can always get on there and, see what's there, but this is not my favorite trade right now. But I like the way it's really obvious support and resistance are really clearly defined in this for the last 3 months. Okay, whenever you see a stock going sideways like this, that's the kind of stock that'll show you where support and resistance are, so you can have confidence to do your credit spread. All right, so we've got that. Let's look at some other stocks now. If you have any stocks you want me to look at, you're welcome to type them in and I'll take a look at them.
Yeah, just put the ticker in the comment section. I'll let you know when one comes up, Greg.
Okay. Now, there's something else. You can also do credit spreads on the market. For example, right now you're looking at the Dow Jones Industrial Average ETF, which basically means, the Dow Jones Industrial Average is an index. You can't trade it. It's just an average price of 30 stocks. But this trades exactly like the Dow Jones Industrial Average. It's called the Diamonds, symbol DIA.
DIA?
DIA.
Okay.
For diamonds is the nickname. There's one for the S&P 500 called the Spiders, SPY. And there's also one for the NASDAQ called the Qs, symbol QQQ. So those three ETFs that trade exactly like the index it follows, you can trade it like a stock, or you can buy and sell options on it. Okay. Kind of makes it like a futures trade, like the ES. So if you want to do credit spreads on any of these indexes to cover the market, you can do that. Okay. And that's great because the market tends to move, ETFs tend to move more slowly and steadily than individual stocks. They're less volatile. Okay, so that's good to know.
Mm-hmm.
All right. Let me look at another trade that I did. This is an alert I just did for Snap.
We sent this out. Was it early this week or?
Yeah, it was earlier this week. I did an alert for Snap, and let me pull it up here. Okay, with an October 8 expiration, we sold a 71 put and bought a 68 put. So the price would be, now this was more like when it was closer down to here. Maybe it was at the beginning of the day there. And you can see it's been going sideways and showing a lot of relative strength when the market was going down. Normally, most stocks would go down with the market. Because it's not, it's bouncing right off the 50-day moving average, that purple line. That's showing tremendous strength. That means it's probably not going to drop below that. So I issued a bullish credit spread to sell the 71 put, and for protection to buy the 68 put. Now that's worked out really well. At some point in the near future, if it keeps going on like this, I'll be able to issue a just sell at a profit update on this. But this one is acting exactly like I thought it would. In fact, it's bounced above resistance. I'm thinking about just buying the stock outright because it's taking off. Ever since the gap up day back on July 23rd, this stock has been very strong. The underlying financials are great for this company. So, sales are increasing very quickly. This looks like possibly even a long-term stock buy, but for now, it just looks like a good credit spread to sell. And as it continues up, to sell bullish credit spreads, to sell the puts that are at or below current prices.
So for now, we're sitting on the credit spread, and you're thinking about buying into the stock itself where it's at, or are you going to wait on a pullback?
No, it looks great. I would buy it. I would buy it right here for a longer term trade, meaning months. Okay, I'm putting on my investor hat a little bit here.
Sure.
For actually for a trade right here, I would even buy in because it's breaking out. It looks so strong. And look at this volume day. Let me see if I can see the volume. On this day, the volume was 26 million. You can see by the by the bar down here, it's higher than normal volume, almost double probably normal volume. And you see huge buying volume on this day, back on the gap up day. All of these things on the chart are showing strength, which means I think that this stock is going to keep going up from here. Looks great. Looks very, very strong. Just to give you a little background on it, look at where it's been. You can't see that, it's pretty small, but a year ago it was trading at 24. So it's 3 times higher over the past year. It's a very nice return. Looks like it's ready for its next leg up.
Was Snap an IPO last year?
What
was Snap?
I forget when it was.
I might be thinking of something else.
Okay, this is going back. Let's go to the max on this. There's the IPO right there in 2017. So it looks like it's been 4 years.
2017. Okay.
Time flies. Okay.
Why? Kevin asked, why would you not buy in the money calls on Snap?
You could do that also. It just depends on how you want to play it. If you're going to do in the money calls, that's great. Make sure that you give yourself plenty of time if you're buying the calls, because you don't want to run out of the time value. Okay, you got to remember with options, the time value is lost most quickly the last 4 to 6 weeks of the option. So that's not what you want to buy. You want to sell those. You want to buy time value of at least, like 3 to 6 months out. You'll have to pay more for that, but you'll hold the value more when you come to sell it. It'll tie up more of your capital while you do the trade, but that's a good thing to do also, buying in the money call. Okay. Do we have any other questions about this before we move on?
Any questions on Snap? Thanks, Kevin.
We can go back to that if you want to. I'll leave this window open.
Well, Snap's an open trade right now, so we'll probably talk about that till it closes, right?
Yeah. I'll be issuing an update on that this week.
Okay.
On this and American Express, actually. Those are the 2 credit spreads I have open at the moment that have been sent out. Okay.
So do you have something new you want to look at?
Yep, let's go to something else. Okay. Viva Systems, symbol VEEV.
We have traded that a few times.
Yeah. Okay. V is looking very weak right now. You can see based on this chart over the last several months that this is a volatile stock. Because it's so volatile, I would be more inclined to buy an option on this probably than sell it unless the premiums are great. Okay, but clearly this thing is in a downward trend. It was in an upward trend until that period right there, August 5th. Now I want to point out to you a couple things you should be looking at when you're placing trades. The success of trading, whether it's stocks or options, is going to be based on largely your ability to do technical analysis, which means we're probably going to do a course with me teaching you lots of things about technical analysis. Okay, here's what you should be looking at for Viva Systems. First off, you should see that the trend is broken right here. You see big down candles on heavy volume, which shows the sellers are really dumping this stock. Now you notice that even though it did climb back up, it bounced off the 50-day moving average right there, which everybody, by the way, should have on their charts. It did climb up. It then gapped down again. Now let me just tell you what I did, not with options, but actually buying and selling the stock. On, was it that day? I think it was that day, earlier in the day. I bought it. It was looking like it was going to fill the gap, so I bought it. And the next day I sold it because I was starting to take a hit and realizing this is actually going the other direction. So I sold it, and then I sold it short. I'm currently short at probably the bottom of that candle, 3.0. In fact, I sold it short that day at about 3.08. And it's had some very nice follow through to the downside. So I'm in this stock profit of about $8 to $9 a share right now. So you should be noticing that it's bouncing off the 50-day and then it goes below it. That's a big sign. The downtrend started right here on heavy volume. And then you should notice that now it's trading below the 50-day moving average, which is very bearish. Okay. I actually expect this to follow through a lot more on the downside, even from here. And so where would you get out, or where would you want to do a credit spread potentially on this? I'd actually want to see more of a bounce like on this day. I don't necessarily like it right here for an entry point. I'd like to see more of a bounce and to see it stop going down, just like it did on that day. So I'd probably want to sell a call around 305.
Sell a call around 305.
And then buy a call for protection a little bit higher than that. It might be 310. Depends on what's offered. Usually at this price, they do $5 increments. So I'd probably be 310. Okay. Now we're going to get a bounce at some point in this. And it could very well go above 305. Personally, before entry, I'd really like to see it bounce up a little bit more and then enter.
So this is not an official alert. This is what we're watching. This is okay.
This is a watching. Yeah, this is not an actual trade right now. We're just looking at potential trades here.
Real quick, so I'm still going to be introducing you for a while, Greg. Ken asked, who we've got here. This is Greg. Greg has been working with us behind the scenes for a while. He's helping us develop a more robust options menu, and he's a trader we've known for a while. We're getting him to help us to basically produce options content. He actually knows a lot more than just options, but this is somewhere where we really needed help because it's probably the thing that's the most requested from you guys, from all our subscribers is, what else do you know about options? Can we get a credit spread? We've literally been asked for different products for years, or different alert services. And we're, right now we're just putting out some free education. We chose credit spreads because it's a safe way to introduce options to a lot of traders who are not familiar with them. So Greg is our buddy, our fellow trader, our pal who is here to help. Thank you, Ken.
Okay. Yeah, just a little bit about me. I've been involved with the markets for a long time, like 30 years. Used to work for Fidelity Investments. I currently manage money, and I've been teaching people about trading for 8 years on my own. And I'm partnering with Ben and Steven at the Traders Plan, like Ben said, to do the options piece. Steven handles the swing trading piece, and we're going to offer more things in the future. Okay, so there's a lot to come. Let's look at IBM here. IBM is clearly in a downtrend. It's trading below the 50-day moving average, and in fact, just a few days ago, it hit below the 200-day. The 200-day moving average is the big one. the granddaddy that investment managers look at. So if IBM fails to stay above the 200-day moving average, that's a huge sign, just huge. And so right now it's bouncing up a little bit. And it looks like they're starting to push it back down intraday. I'm going to go to a 5-day intraday chart. And that's what it looks like. It's really valuable to follow a stock during the day if you can, if you have time, and to go to Yahoo Finance, which I love. I've been using it for a long time, and to look how it's moving intraday. Okay, and we see it bouncing up right here, but it's failed to go any higher. Let's go back to the 3-month. Okay. Now, I'm of the opinion that IBM is going to drop down further. I think it's going to bounce a little higher, but I think it's going to go back into a downtrend because it's just a huge stock and it's hard for it to maintain its sales because it's so big. It's been around like 50 plus years. Okay, so we can do a real trade on this one. If you want to write this one down, Ben.
All right.
Okay. Right now the stock is at 136. I would want to see if I can find the actual prices on this as far as what we can get for the options. But I would want to write a call, to sell a call about 138, 39. Let me see if I can find what's available. Are you seeing my options chain on your screen, or is it showing the other still?
It's still showing the other.
Okay. Okay, my computer is running pretty slowly, so I'm not getting quotes very fast on this.
You're looking around 138?
Yeah, I want to see what they'll offer at those prices.
Mm-hmm.
What's available. Okay, yes, they do offer spreads options at every dollar increment.
Okay.
So we could sell, let's see, where are we? It's September 23rd. Let's go to October 15. Okay. We could sell the 139s, October 15th, excuse me, October 8th.
October 8th, 139.
139s. For that, we could get about 90 cents on it, or $90 for the 100 shares. The spread on it is 83 cents to 98 cents. We want to do a limit order and capture the majority of that money for income. So we'll sell the 139 IBM.
Sell
October 8th.
39 IBM call.
We're going to get about 90 cents for it. If you can't get most of that, might go down to 85 at the most. If you can't get that, don't do the trade. Do limit orders always for options. Because I've seen some huge spreads on some of these, and it's not worth it if you can't get enough money for the risk. Okay. And then I'm going to buy, say, the 142s for 30 cents. So you're not getting a huge spread on this, a huge income, I mean, for doing this. So you can do more than one spread. You can do 2 or 3. Now, how do you determine how many you want to do? Well, first, it's based on if you think the stock is going to go up or not. If you think it's going to go up there, you don't want to do that trade. Okay, I don't think it will, so I'm willing to do the 139s. Okay, if you disagree with me, that's fine. You don't have to do that trade. Okay, so we're going to get about $60. So again, how many trades? How many credit spreads can you do? Well, what's the risk on this? You determine the risk by the spread, the difference between the spread. That's 142 minus 139. That's $3. That's $300 risk minus your income, which was $60. So the max risk on one credit spread on this trade is $240. Okay, so if you can risk almost $500 for a max loss, you can do 2 options. For most of you, I'd say maybe not. If you're new, you should try one at a time. So you got to keep in mind that the further away the option is that you're doing, the less money you're going to get per credit spread, but the less likely it's going to be filled. The more likely you'll be able to keep all the money. Okay.
Got it. IBM.
Okay. So we've got one currently at 136. You have to remember, though, even though we're going to write the 139 call or sell the 139 call, that because we're getting paid for it, break even is going to be even higher than that. So it would be 139.60 is break even. Could it go up there? Yeah, it could. Do I think it's going to? No, I think it's going to go to a downtrend. Now, if the downtrend continues, like I suspect it will, sometimes the option will drop in value real quickly. You can ring the cash register, lock in your profits, and exit the trade. A lot of times you still have to wait a couple weeks, even if that happens, because there's time value in the option. Okay, there's 2 types of value inside of every option. You got the potential, which is time value, and then you've got the intrinsic value, which is whatever the stock price is above the call price or below the put price. That's called the intrinsic value. It means if there's no time value left, that's what the option would be worth.
Okay. Any questions on this trade? No questions. Kevin in at a 45 credit or 54 credit.
Oh, he's talking about Vive back there. Do you have any stocks you want me to look at?
Any tickers, guys? So far, we've got a trade that we can get in. We've got updates on American Express doing its thing and Snap, which is looking strong. And now we've got IBM to play with. So any tickers we want to look at right now, or
okay, just keep in mind that
SLV
on all these trades, we have about a 70% odds. If we were to enter the trades, do the credit spread, generally we have about 70% odds of being successful in capturing all the credit. I kind of like to write my spreads away so that they're less likely to be, to be filled. If you're aggressive and IBM starts to show a downward, its next leg of its downward move, kind of an upside down J, where it curls up and starts to head back down, You could be aggressive and write a credit spread at current prices. Like you could write a call at 136. Remember, they're not likely to be filled or sent to you, and you forced out of your sold option until expiration. Most options, even if they're in the money, tend to be filled right before, like a few days before expiration. Just because it's in the money doesn't mean you're going to be, it doesn't mean the option buyer is going to exit the trade. Doesn't mean they're automatically forced out of the trade.
We've got one ticker, SLV. You know, look at that.
Sure. SLV, silver. Okay, look at the metals.
Steve would probably have a lot to say on silver.
Wow. So just 2 seconds looking at silver and knowing about metals, I wouldn't want to be probably writing a credit spread on this at all, ever. Just because it's so volatile. I mean, this thing could bounce. I mean, there's all sorts of gaps on this chart. And so it seems to me easily likely that if you write a credit spread on it up or down, it's going to be, not work out. Depending on the prices, I'd probably be more likely to buy an option on this. And since it is clearly in a downtrend, I'd be probably buying put options. I do not want to write credit spreads on something that's volatile.
There you go. So potentially buy a put, you wouldn't do a credit spread though.
No.
Just too many gaps.
No, I would not want to touch this with a credit spread.
I remember Steve chasing silver earlier this year. It was doing the same thing. AAPL.
One more thing before we move on.
Yeah, sorry.
To enter a put option or a short trade, I would want to see it do what it did right there. Come up, kiss the 50-day because it's in a downtrend, and then enter it. That's going to be your highest odds of success by doing it up here. I wouldn't want to buy a put down here. It might work out, but I'd much prefer to see it bounce up here and get better prices.
Sure.
And then go back down. Okay, what was that?
What's that resistance level at?
It's the purple line is the 50-day moving average.
Right.
That's what I'm looking at on this chart because it's
got it.
Every time it even gets close to that, they sell it off.
Sure.
And it's in a downtrend, so that's what I'm looking at. Even though it's in a downtrend, it could very likely bounce off the bottom of the Bollinger Bands here. Bounce up towards the middle or higher, up to around $21, $22 a share, and then come back down. That's the pattern what it's been at in the past month or two.
Mm-hmm.
What was that other ticker, Ben?
AAPL.
Oh, Apple. Okay. Okay. Apple and the FANG stocks, Facebook, Apple, Amazon, Netflix, Google, these have been the stalwarts. They are huge companies. They've been able to do really well in spite of, problems in the economy. Amazon benefited huge, of course, from the pandemic because everyone's buying stuff on Apple from home. So Apple put in a long-term high back on just 3 weeks ago. And then it's come all the way down here. It looks like it's starting to pull its way back up. Actually dropped below the 50-day because of the Evergrande thing on Monday. Gap down, and it's been working its way slowly back up for the last 4 days. I think I would want to. I want to wait till tomorrow. I want to hear what happens with this Evergrande thing. See if they're going to make their bond payment. If they do or if they don't, I want to see how our market reacts to that. But you got to remember, Apple does a lot of business in China and internationally. We're not the only people who buy iPhones and iPads and everything else. So I want to see if this is actually the beginning of a new downtrend or if this is just a little pullback. The chart does not make clear which one of those it is. So personally, I want to wait. I don't want to enter any trades on this right now. If you want to risk it, it's very risky, I think, at this point. But if I had to bet, I'd probably bet on the long side. I think it could work its way back up to new highs before the end of the year. And so someone who likes to live on the wild side could sell a 143 put if you think that's going to happen. Don't do it till after you hear what happens with Evergrande tomorrow. Okay. But that's what I think of this. I want to wait before I do a trade on Apple.
But if you are on the wild side, Stan, you know what to do.
If you like to, you don't mind rolling the dice. Okay.
Why would you buy the put versus selling the call? Any reason?
Okay, so
or buying the put versus or selling the put versus buying the call. Like
okay.
So
right now, let's say you're bullish. I'm slightly more bullish than bearish at this point on Apple. Right where we are right now.
Sure.
So if you're bullish, there are different ways you can do the trade. You could buy the stock.
Mm-hmm.
And if you did that, you could buy it here with a low below the low of this day, which was around 141. So that's almost $7 a share if you wanted to risk that. Okay, and then the anticipation would be within a few weeks, it's going to be up to 157, which is not worth it as far as risk versus reward in my book. So anyway, you could buy the stock outright. You could buy an in-the-money call or at-the-money call. Or you could sell a put if you don't think it's going to go down there.
Sure, but why? I mean, what would trigger you to sell that put versus buying that call? I mean, I realize you're playing the long either way, but like, is there any reason why you do one versus the other?
That's kind of a complicated issue, actually. We could do a whole hour on that.
All right.
On which why you would want to do one or the other. Of course, this is a credit spread class, which is for income. Right. And so we're talking about income right now.
Sure.
When you're doing credit spreads, I like to do nice, predictable, not very volatile stocks with a high likelihood of me just walking away with the money, free money.
Okay.
That's what I like. So I want a steady, slow, predictable mover like IBM.
Understood.
Occasionally, IBM does have a big move, but most of the time not. Most of the time, it's like a cruise ship. It doesn't turn very fast. It doesn't move very fast. Compared to a tech company like Amazon or something that's a speedboat that's zipping, tech stocks are volatile.
Sure.
Okay. We can talk about that. When you're doing stocks, it's all about risk versus reward, how much you could make versus how much you could lose, because it's 1-for-1 directional on whatever the stock does. It's different when you're writing or selling options, because all you're interested in is where you think the stock will not go to. Okay, so right now, if I were to sell a put down here around 142, 141, if the stock goes up, great, I make money. If the stock goes sideways, great, I make money. If the stock goes down to the strike price, 142, I make money, all of it. All the credit I get to keep. If the stock goes down a little bit below that, I break even. The only way I'm going to lose money if the stock has a big move down from here. Okay. So I'm likely to make money if I'm right about that. And so if I do a credit spread and I write and sell a credit spread, I want to be pretty darn sure it's not going to do that. It's not going to go down. And I'm not sure about that right now with Apple. It looks like it may have just started a new downtrend. It did bounce off the previous support level right here. From that date, you've got sideways action in Apple with support around 142 and resistance at the previous high a few weeks ago. I still think it'll probably go up to new highs by the end of the year, but I'm not convinced, and can be a pretty volatile stock, so not my first choice for writing a credit spread on this, for executing a credit spread.
I played Apple.
I would sell a 142 and buy a 138 or something like that, depending on the prices, the money, the cost of the options, and the price I get for selling the put, both of those.
Solid advice on the credit spread side. He's right. Playing it the other way is definitely it's a gamble. I played Apple a lot last year before the split.
Yeah.
Made some really good money with it, but it was also one that could flip on you real quick.
Were you buying and selling stock, or were you doing options, or what were you doing?
I was buying calls.
Okay.
And buying calls and puts. I was playing it a little risky last year, and honestly, that was kind of how I got away from options. Was I was doing a lot of the wrong things, and Steve had warned me and got me. Steve is all about the rules and had me trading stocks a very specific way, but I started dabbling, and last year was really fun for tech options. A lot of fun. I know a lot of people on here who do trade options probably made some money. But you got to understand the risk, and credit spreads is definitely a safer approach to it.
Yeah. If you're interested in steady, safe income, credit spreads are the way to go. You're instantly paid when you do the trade. And so a lot of people generate good money doing credit spreads monthly. Okay. I mean, they have like 70-80% odds of success by doing it. I did, just for statistics sake, I did like 10 options trades, and I was right 90% of the time out of 10. Did 9 out of 10 profitable. And profitable on 9 out of 10. And then one was a slight loser. It wasn't even that bad. It wasn't a max loss. So you've got to read the charts correctly, and you've got to know when you're more likely to do a safe trade. So being good at technical analysis is critical. We could do a whole workshop or conference on technical analysis.
You should. We'll dig more into it. I love where this class is going. I've learned a lot already. I
want to teach you one thing about technical analysis. This is one of my secrets right here.
Okay.
So this is Fidelity. Oops, not do that. This is Fidelity National Information Services. You see where the stock gapped down and then bounced up a little bit and went sideways? And I wrote a horizontal line above it. Can you see that?
Yes. I've got a couple. Yes. Okay.
Okay. Look at those little tails on top, those little lines that go above the stock. You see how they all top out at almost exactly the same price? You see that?
Mm-hmm.
Let me see if I can make it a little bigger.
There you go.
Okay. Whoa, that's very big. My computer is moving slowly. Anyway, look at how closely that stock tops out at almost exactly the same price. Once, twice, 3 times, 4 times, 5 times, 6 times. Let me tell you what's going on there. After the gap down, the stock bounces up just a little bit, maybe 25% to 30% of the gap down price. What's going on there is some hedge fund manager told his trader or her trader, I want you to sell every share that you can at a given price. Don't push the stock down, but sell as much as you can at that price. And so this is what you see. You see the stock attempt to rally and it bounces off a certain price within a few cents. And you see it do that multiple times. That is a sign or a signal that there's some heavy selling pressure at that exact price. And the stock is likely to drop after that. Because at some point, they'll stop buying it at that level. And to sell more, they have to push it down. That's exactly what happened here. Now,
how long have you been watching that, Greg?
What?
How long have you been watching that?
I think I just pulled it up the other day. I hadn't seen this when it happened.
Oh, no, I meant these tails in general.
Oh, years. This is one of my favorite secret things.
Good. Well, there you go. Question: Does
this
Greg?
Is not widely known. I've never seen anybody teach this before, but me.
Here comes a question: Does Greg have his own service? We are launching that service with Greg. What did we decide? Was it the first week of October? It's soon.
Oh, let me see. We said what was
October?
It's October 8th.
Yes, it's the first week.
October 7th, Thursday. I'm going to do a presentation on. What did we say? Technical analysis or options or both?
It's going to be a little bit of both. We've got a hybrid presentation, but that was when we were going to launch, an alert service with Greg. We're trying to get people familiar with him and get comfortable with what people are enjoying, get comfortable with him and figure out what people are enjoying and what would really help. It's definitely going to be around credit spreads, but options income, is the goal with Greg. So stay tuned for that, but keep coming to the show and giving us, any feedback you can. As long as it's constructive, I promise we'll take it into consideration.
Yeah, we're open to hearing what you want to hear from us. Because I know a lot about the markets. I can teach you whatever you want.
Yeah, we're trying to put a good options product together. I mean, the reality was Steve, is great with so many areas, but he wasn't as familiar with options. So it would be, it was something we had to do. We had to find somebody that knew more than we did. And, this is why we started talking to Greg. A lot of people, though, a lot of people in our industry would have just pumped out products and just said, deal with it. Our responsibility to you guys was to find somebody that knew more than us.
I was willing to work with Ben and Steven for that reason, because I'm only interested in teaching quality. I care about people. I want people to make money in the markets. A lot of people really only want your money. They don't care. And we're not like that.
Anybody who's been in this industry for 5 minutes, it's kind of black and white. There's some really shady people in it. But, dude, we're glad to find you. We're glad to work with you. You've been great for our members. And, I really appreciate you taking all this time to put out this free content with us, for just to get to know us and to get to know everybody. Well, I've learned a lot. I'm starting this separate options trading account I've talked to you about. I really look forward to following you as well. So it's not just you guys. I want to trade with Greg as well.
Well, I love the markets. I love helping people. I do this all day, every day, as much as I can to help people, but also I, manage money. So I'm looking at the markets anyway. I'm constantly staring at Yahoo Finance.
We might as well be watching it with you.
Exactly. That's totally my attitude. So we're going to look at lots of stocks. I'm going to issue alerts. And I'm going to be issuing updates about how to manage the trades, which I am about to do today on those two stocks, on American Express and also on Snap. And
we are going to be doing text alerts with this. I know that they're very time-sensitive trades, and I know with the reversal alerts that we, which is us attaching a call option to the reversals trades, if any of you guys are in that subscription, that didn't have text alerts with it. There was text alerts on the stock trades, but not on this. So we were bringing in new software and, trying to really make it a very user-friendly service. And with that, we just couldn't pump it out like right away. Greg and I have to sit down and learn this new software to be able to send these texts out. So that's what it was. Kevin, I'm on I-40 north of Little Rock, Arkansas. Greg's somewhere in Florida, Pensacola, Tampa.
I'm in the Tampa area. I'm west. I'm actually in Largo, Florida, about 10 minutes from the beach. It's nice. I like it.
Well, it just turned fall here, and it's starting to get nice, man. But I was over that heat. So yeah, that's Greg and I. Steve couldn't make it today, but usually he'll be on here with us too. But it's almost better because Steve and Greg have they really think a lot alike in this sense. So it's good for me to be able to ask questions because I truly am, very green with the credit spreads. And, I've got 3 pages of notes, and now I'm going to start putting these into practice myself. And I'm going to have an account that we can monitor on here as well. So looking forward to seeing where this goes. And I appreciate your time. We're at 56 minutes. I'm going to shut this off in an hour, like I said. So is there, real quick, any tickers, Kevin, anybody, one-time presentation weekly? Right now, this is a one-time free presentation. It probably always will. We'll have, and we may put out another one for members as well, something where we're looking at more trades, because there will be more trades in the membership than there are. But we're going to have a free class weekly for the foreseeable future. That's right, Greg?
Yeah, that's right.
So a free options class for the foreseeable future. And, for those who decide this is something I really want to get in on, we may have a smaller, more intimate private class with that as well. But, if you're either way, like you can come to this all day for free. Well, all day. You can come to this weekly for free for sure. I keep forgetting to put our faces back up because of this whole screen. I want to get it to where our screens are at the bottom, but sometimes it's really important to have that full screen on there. Membership cost to be determined, Kevin. We reasonable and worth it. But we're looking at some options for the options product. When I say options, we're looking at, potentially multiple, like a quarterly or an annual or a monthly. So that's still some things we're definitely going to have ironed out by the 7th, did we say? Good questions. Thanks. But we're still very much trying to figure all that out.
Working out all the details, but definitely options alerts. And if you're going to do options alerts with us, you need to have timely information.
Right.
Because as the stock price moves, that can affect the options price quite a bit.
Right. And one of the biggest things that we really had to do here was to really upgrade the software to be able to do that, or bring on this new software. So that's part of it. It's just, there's a lot of moving parts to just make this a very strong product. We've been getting emails, about what we could do. So we're kind of like pulling them all together. So if you have any suggestions or, things, just email me at support@thetradersplan. I can promise you this. We're going to have phenomenal support, just like we do with the Traders Plan, where your emails will be answered in a timely manner. Greg will be managing, the email account for that. So we're getting there. But for everybody who's just joining us and helping us to create this, thanks so much. It's been fun. Let's see. Any tickers for today? We will wrap this up. So just to recap, we took a look at a trade with IBM today. I'm getting in this trade with IBM. We looked at the downside of credit spreads. The American Express went the other way on us. It's going to happen. And then we also have Snap, which is looking strong, right? So thank you. Thanks for coming. So that's where we're at right now. We've got Snap looking strong. We've got IBM joining the boards. Are we going to put out an official alert, or was that kind of like an in the class alert?
I can look at IBM and do an official alert, with the exact prices and everything. So yeah, we can do that.
Okay, so if you haven't got in there yet, keep an eye out for that email. Right now, we're just blasting that email, not on a separate list yet, but eventually we'll start, funneling people through that are actually interested and get them the alerts directly. But you don't have to worry about missing that right now. So IBM's our new trade. Snap's looking good, and we'll see. We have no real risk in hanging on to American Express right now, right? Like it went the other way on us in the worst.
Yeah, that's right. We're at max loss right now, and
so what if it hasn't been assigned and it just goes the other way?
That could happen, and that's what we're hoping for.
Right. Somebody gets greedy. They sit there and hold it.
Yeah, because most of the time, options are not exercised till near expiration. And so what we're hoping for in that trade is that it has a nosedive, and then suddenly what was max loss becomes 100% profitable, max profit. It could happen. That's happened to me.
Oh yeah, I like being on the other side of the fence here.
I like when losses turn into wins.
I do, because playing the other side of options, had its fun, but it was a roller coaster. So this is entertaining and a good education for me. So, all right, thanks everybody. Great show, Greg. I wanted to say happy Friday, but we're not there yet. We're close. So next show, we'll definitely have one on Monday. Greg, you should join us. Steve and I were trying to get our show going on Monday to get the week fired off. Steve's trades. I'll send you a link for that. So I'll send everybody a link Sunday for Steve's show on Monday. We'll send out the potential IBM trade. And everybody, thanks for showing up. Have a great day. How can we see the actual trades you placed? Well, right now we only have 2 live, and they've been going out to the email list just to everybody. Hey, Lou, if you email me at support@thetraders.plan, we have everything that's been going out live. I don't know that we've put them in one place yet, since there's only 2. Again, we're still getting this rolling, and we should get a rolling list though, Greg.
I've got a spreadsheet I keep.
We should just put that in the emails. You know what I mean?
Okay. Sure.
Look, Lou, great question. What I would like to do is I'm going to get a page set up, and we'll keep a rolling list of these trades on that page, just a rolling Excel sheet. And that way, while we're still getting the details ironed out, we can have those trades for people to see. Good idea, Lou. You just found out it doesn't actually exist yet, but it's about to. All right. Thanks, Robert. Thanks for all the kind words. We appreciate it. Y'all have a great day. Thanks, Greg. I'll talk to you soon.
Thank you. Have a great day.